All right, so I will start again. Uh, this is a lunch and learn on agricultural community development financial institutions with California Farmlink. Our presenters today are Poppy Davis, who's an agricultural business and policy advisor out of California, and Reggie Knox, who is the Chief Executive Officer at California Farmlink. So I will let those two take it away from here.
Fantastic. Thank you, Emily. I'm Reggie Knox. As Emily said, here in California, Santa Cruz County, Aptos, California. And I've been with Farmlink for 19 years, and I've been working for my whole career pretty much in the nonprofit sector with mostly California nonprofits, including Certified Organic Farmers, Community Alliance with Family Farmers, et cetera. But a long stint here with California Farmlink, and have been kind of managing the process as we grew from 501c3, more traditional farmer service and education program to a lending institution and a community development financial institution. So as Emily said, our lunch and learn today is about what is an agricultural CDFI. And with that, I'm going to go ahead and share my screen and share a few slides with you all. Okay. How's that working? Good.
Yeah, I can see it. It just
I
needs to go to present mode or whatever.
You enter full screen. There we go. Okay, better.
Reggie, if you do view slideshow, you may or may not blow up your whole screen, but it will look better for us.
Okay.
Yeah, that's better for us.
One step better.
So
Thank you. Okay.
Good. Okay. I always cross my fingers when that happens.
Yeah. So this is our mission. In fact, a recently updated and revised mission, because the organization has been growing. We've added, we now work with fishing businesses, small fishers who have limited access to financial resources. Our mission now includes the words community development financial institution, which is a designation of the Department of Treasury. And we've been certified as a community development financial institution since 2013. And I'll just say at the outset that once we became a lender, we had to become a loan fund first to kind of prepare to become a CDFI. And then we got that certification in 2013, but that it requires us to provide 60% of our loans and our volume of money that we loan to low income farmers and Latino and Latina farmers. Let's see, what's the, there we go. So the people that we serve are challenged by just finding land, leasing land. As we've grown, we've served more people with farm mortgage loans, so buying land, but that's a small percentage. Most of the farmers we work with lease the land that they own, because a large percentage, more than 50% of our borrowers are Latino and Latina. They have limited English language skills, often limited banking relationships or credit history. Of course, there's a long history of discrimination against people of color in lending. Often they lack, assets at all, maybe just a little bit of used equipment and that kind of thing. And banks don't like to make the kind of small loans that we make because they're just not profitable. Okay, oops, sorry about that. Basically, we have two main programmatic areas: our loan program that provides a lot of annual operating loans, because that tends to be the biggest need with these farmers that we're serving. Just a 10 or a 25 or a $50,000 loan to buy seed and fuel and maybe hire labor, one or two folks. These are often 5, 10, 20 acre mixed veg and berry farms. Land loans, for the more well-established farmers, and as we've grown, we've been able to offer about 45 land loans historically since becoming a CDFI, and equipment and infrastructure loans, and then last few years we've also been offering specific conservation loans that incentivized with low interest rates the implementation of conservation practices, working often in collaboration with local RCDs here in our core lending area, which is kind of Monterey Bay area, the three counties here, Monterey, Santa Cruz, and San Benito. But we've grown to, and we've made loans in about 40 counties now in California. And then the other big programmatic area is the education side, which we call land and business programs. We provide a lot of lease support and land access support, as I alluded to earlier. We have very well-developed curriculum that Poppy will be talking about shortly in business development and management and financial management. We're starting to do some train the trainer work within the education program. And that was sort of the highlights right there. We also do some farm succession planning. So just a quick timeline. We became a nonprofit 501c3 back in 1999, so we're about 24 years old now. And until for the first 7 or 8 years, we didn't do any lending until 2007, when we had raised enough capital to make our first loan, but that was through a partner CDFI. We didn't have our lender's license in the state of California or our CDFI status yet. Got our lender's license shortly thereafter. And then an important milestone was getting our Farm Service Agency Guarantee Authority in 2011. And those steps enabled us to be successful with our application to the CDFI fund of the Department of Treasury, which provides us with more access to capital from foundations and banks principally, as you'll see in a minute. Started making land loans in 2015. Started working with the SBA in 2018, and then expanded to fisheries just a few years ago. So as I mentioned, a large percentage of our borrowers are farmers of color, historically mostly Latino and Latina, but also increasingly in the Central Valley, Southeast Asian farmers, Hmong and Mien farmers who came in multiple groups over the decades into the Central Valley as refugees, and many are continuing their traditions of farming. During the pandemic, we partnered with organizations serving Southeast Asian small businesses and farmers to greatly expand our reach within that community. We did those Paycheck Protection Program loans to about 54 Southeast Asian farmers, in fact. Most of our borrowers are low income, and it's certainly commonly known that many large percentage of farm workers are undocumented, and it also turns out that a substantial portion of our borrowers, the people that we're providing capital to, are also undocumented, which we refer to as ITIN borrowers. Those are people who have individual taxpayer identification numbers instead of Social Security numbers. by the way, I wanted to mention at the beginning that our intention is, I'm going to turn it over to Poppy in a few more slides, and our intention is to kind of go through all these slides and then leave plenty of time for questions, about half of the hour for discussion and questions. But if you do have a burning question as I'm talking, we can certainly take a few, or as Poppy's talking, during the course of the presentation. So what is a CDFI? As I mentioned, it's a program under the Department of Treasury that came to be in the early 90s. It was under the Clinton administration. And CDFI, the CDFI fund grew out of the civil rights movement ultimately. But in particular, it grew out of the long tradition of discrimination in banking called redlining, when banks just categorically often excluded low-income communities and communities of color, especially in large urban centers, and told their loan officers, no, we don't lend in that area. And I was recently in a state legislator's office where they had a beautiful old redlining map, and I hadn't actually seen a original redlining map up on the wall, but it was really a thing that communities were completely excluded from bank services. So one of the things that grew out of the civil rights movement was the Community Reinvestment Act, and which predated, which is one of the regulatory frameworks for financial institutions that predated the CDFI fund. So building on that regulatory framework, which required banks now to lend to all communities, including communities of color and low-income communities, based on their footprint and where they are operating. The Clinton administration championed this CDFI fund that would make it easier for these alternative financial institutions called CDFIs to get money into these to access capital and get money into these low-income areas. As I mentioned, 60% of our capital must go to low-income people and farmers of color. Let's see. And the CDFI fund, the last bullet there is the CDFI fund, provides us with an annual grant and up to $1 million. But there were a lot of additional funds that came through during the pandemic in the last few years, including a $1.8 million grant that we got, and many other CDFIs due to a large injection from Congress, because CDFIs were seen as critical in getting funds out to distressed businesses during the economic challenges that people were experiencing. And so they've kind of grown in stature over time and had a lot of bipartisan support across the aisle in Congress. So while most CDFIs focus on urban community development, Farmlink has taken the model to focus on farming and small. So we're a small business CDFI, akin to many other small business CDFIs, which are still a minority in the CDFI world. So let me say this. 80% of CDFIs are loan funds. They're technically, so they're financial institutions. We don't consider ourselves banks because we are not depository institutions. We don't take people's savings and use that to lend. We instead get investment from both the government and from private foundations and from banks. And the other 20% are divided between credit unions. A handful of banks are actually also, that are not credit unions, are certified as CDFIs, and then there's some venture funds as well. But by far, most of the CDFIs are working in urban community development, particularly on affordable housing, as well as public health care, health clinics, and that kind of thing. And then there's this minority, but still a substantial number of the 1,000, approximately 1,000 CDFIs nationwide. I think there's about 60 or 70 in California, for example. I'm not sure how many in Washington State, but probably a substantial number. So that focus on small business. And then within small business, again, some of them focus on both rural and urban small businesses, but there are very few, there's only a handful of us, like under 5, who really have an exclusive focus on supporting farming and the farming industry. And small farmers in particular, underserved farmers and low-income farmers. Let's see, and what we've learned, especially with this, you saw that we have some funding from the Kellogg Foundation to give these kinds of presentations and try to share the information about our agricultural CDFI model with other organizations, including other CDFIs that might be interested in getting into agricultural lending, but they're just it's such a different animal, agricultural lending, that most CDFIs are we don't want to go there. We'll just send them to Farm Credit typically, or to maybe a community bank. But there are some Farm Credit organizations that have smaller loans, but they're few and far between. So there are many states that are really don't have CDFIs or strong alternative lenders serving our agricultural communities. I've alluded to our financial model that includes, funds from both the CDFI fund, grants from the CDFI fund that we can use for lending or for operating, as well as USDA grants that probably many of you are familiar with, for education and that kind of thing. And private investors in our loan fund, loan guarantees that we use from the Farm Service Agency and from the state. We sell some of our loans on a secondary market. I'm not sure if we'll have time to get into that, but we can explore that later as necessary. And then, so the revenue that comes into California Farmlink includes our loan capital that is segregated, that is not part of our operating funds, but these pie charts are focused exclusively on our operating funds. So our budget this year, for example, is $6 million, and about 45% of that, more than a third, is we anticipate will be from earned revenue from our loans, the interest and fees on our loans, which are below market rate, pretty much, especially with the interest rate rises, typically below market rate. And we have special programs where the loan interest rates are subsidized, and that kind of thing. And then, let's see, foundations and bank grants. Banks are a pretty small percentage. Government contracts about 20%. So you can see, and it fluctuates a little bit from year to year, but generally I would just say overall, it's about a third earned income in the last few years, a third foundations and banks being a small portion of that, and then a third government contracts. So this slide looks exclusively at our loan capital, the money that we use for lending out to farmers. So it's the total amount of capital that we have to loan is 23 million. And because about half of our loan volume is those annual operating loans or equipment loans that might be more than a year, but maybe only 3 or 5 years, the capital constantly recirculates back into our loan fund. It revolves, and that's how we've been able to make almost 60 million in loans to date, with a pool that has reached now this year 23 million. This slide just shows our annual lending per year and how it's kind of grown. And, you know, during you can see the downward trend for the last few years in loan volume. People have been more reticent to borrow with the, you know, economic environment, the way it's been post-pandemic, and all of the impacts that people experience with their markets and having to shift to sometimes to more direct marketing, loss of institutional markets, and that all that kind of thing, and then just general reticence to you know, take on a land loan, but that the trend is already reversing as we anticipated this year. So it will probably, we're anticipating actually 13 million so this year, and that in lending. Let's see, and 25 million over the course of this year and next year. Yeah, and our loss rate is very low. You would think that these are, you know, considered to be high risk borrowers, these smaller farmers that are less well established and have fewer resources, but we have a very hands-on and relationship. Many of them are participating in our educational programs, so the lending and the education go hand in hand, which helps manage our risk and keep our loss rates low. So I've mentioned, you know, our relationships with USDA programs, include Farm Service Agency guarantees, rural development for loan capital and operating funds. We also have a relationship with SBA, and then of course with the CDFI fund. We use a state guarantee program in our state economic agency called iBank. We partner with retailers in some cases, in that they put up money and share risk with us, and we provide a reduced interest rate. Like instead of a 6% operating loan, you might get a 3% operating loan if one of these food co-ops is sourcing product from you in that partnership. Same kind of thing with distributors who serve these small farmers, typically the more mission-oriented retailers and distributors that we'll partner with. And then of course other farm education programs like the Ag Incubators, the Ag Land-Based Training Association in Salinas, and others. And at this point, I will turn it over to Poppy. And Poppy, I'll stop sharing, and you want to share your screen?
Okay.
Okay.
Hey, everybody. You know, my relationship with NABC is largely through one of the education programs. So I work a lot with California Farmlink, developing their land and business program. There's 3 programs under land and business. The first is the sort of the flagship and the oldest, as Reggie mentioned. We started out many years before we became a lender. We were really focused on land linking, hence the Farmlink name. So the whole idea of getting farmers access to land was the original, you know, baked in when California Farmlink was formed. We still do land listings and lease and purchase technical assistance. The lending came very naturally out of that, because that was, you know, one of the largest barriers to land acquisition was financing. We also do succession planning under this Equity and Conservation on Working Lands program, because the years following a change of primary operator due to death is when most land is lost out of agriculture. It's not right upon death, it's in the years that follow, because the estate plan didn't adequately address the issues related to keeping that land in agriculture. So we keep that education program in this equal program area, because it has to do with farm business viability, but in this sense, it very much has to do with preserving farmland. for agriculture. Key partnerships we have in this program area are with land trusts. And as land trusts buy agricultural easements and conserve land for agriculture, one of our roles there is to work with them to help make them comfortable in making sure that those leases and land tenure opportunities are made available to BIPOC farmers that the land trusts themselves may not be quite as advanced in their cultural competencies and their linguistic competencies, and also just straight up in their familiarity with agriculture and their ability to know how to make a good agricultural lease, because they're really focused just on the conservation side of things. So really critical partners there to make sure, and the whole idea of this program, equity and conservation on working land, equal. It's providing access, good quality land tenure opportunities, access to that high quality land tenure that a lot of the land trusts have. The other key partnership then is with the RCDs. And I know you have strong RCDs in Washington State, and I've been working with some of the RCDs, great partners. So that's our other strong partnership there. It's collaborating with the RCDs where they provide the technical assistance on conservation practice adoption, and then we provide the funding backstop really, so that the farmers have the funding to adopt the conservation practices. The other program is resilience and wealth building, and that's where I've met lots of you through the Northwest Resilierator. So the Resilierator branding and content and curriculum has been developed in multiple partnerships across the country, but it's always been led by California Farmlink. From the very beginning, California Farmlink was sort of the lead partner on developing all the different components that make up the Resilierator. And so, you know, sort of has that model, the best built out, which means it's moved it now into a full-fledged Spanish language program, the Resilierator, which is as made up a word in Spanish as it is in English, but it works in both languages. The curriculum is very similar, but the presentation style is a little different in Spanish, much more emphasis on in-person. We were doing both in person until the pandemic. The English language program was able to pivot pretty easily online. The Spanish language program also went online with some success, but there was a strong agreement that they would rather be in person, and they've gone back to in person. Whereas we found with the English language program, and California is such a big state, we were really delighted to see the diversity from across the state that we were able to get with a fully online program. And so we're going to stick with the online and English language version because it's really allowing us particularly to serve the far north and the far south of the state that have always been particularly challenging for most of the ag organizations are in the middle of the state. And those stretches are easier now with the Zoom-based teaching. And then post-Resilierator programming, we have an exciting new program coming online funded by the Aspen Foundation to focus on high quality jobs in agriculture. Coming out of the Resilierator, one of the most common requests we get is for support in becoming a good, legally compliant employer. We spent a lot of time in the Resilierator convincing people that paying people under the table is one of the worst decisions they could possibly make. They believe us, and then they say, now what? You know, you've convinced me to go legit. How do I do that? And we realized there was so much content there that we needed really another full-blown multi-week program. So that's launching this fall. We're super excited about it. And then we'll pilot it in Spanish probably next year. And then we're just constantly working at other ongoing educational opportunities that are mostly for people who've gone through the Resilierator or the Resilierator, so they have a strong foundation in the business framework that we've laid out, and now they're ready to take a specific additional deep dive on a subject such as employment or inventory or a specific area of taxation or regulation, whatever it may be. And those offerings, as they're being built out, are a combination of synchronous and asynchronous learning. And that's all still, like Reggie showed you the graphs of the lending going steeply up. It's pretty much the same with our educational program, steeply increasing. This is just a little bit of the publicity that we use around the Exhilarator and the Exhilarador. And then our newest program area is business and innovations. This is where internally we work on quality control and ombudsperson functions, one-on-one technical assistance, starting out with loan readiness, but also for more advanced issues where the group education doesn't work. They need really one-on-one guidance on a particular issue. We're focusing now on assistance with state and federal disaster relief, which can be very challenging for farmers to access. There's one USDA program right now that is marketed as being the easiest thing ever. We've got 2 highly intelligent people with advanced degrees who've spent weeks figuring it out in English. So no, these programs are not easy to access, even with a lot of education, and even if you spend your life reading documents to make a living. So good luck if you're a farmer, right? So we're focusing on that as a technical skill to provide that application assistance. Constantly building out the ecosystem of service providers. That would be events like this, which we want to steal from NABC. It's a great model for engagement. But we're constantly looking for bookkeepers, accountants, and attorneys that have the cultural and linguistic competencies and frankly the attitude that we need to do a good job of serving the farmers and ranchers that we serve. And so working on that to do train the trainer programs and give some of that same business training to those service providers, help them understand the things that are unique about agriculture. We also do state and federal policy advocacy as it pertains directly to our programs and the people we serve. And then occasionally special projects. This is an example of a special project, special funding from Kellogg to talk to you to make this model of an agricultural CDFI more widely known. And we're also working on a pretty exciting project right now, helping a group of strawberry growers that are in a little bit of an isolated area from a mainstream farming area. Just like a 20-minute drive, but that 20 minutes makes a big difference in their ability to get their product properly cooled in the heat. And so we're working on some solutions for getting them appropriate cooling capacity. Just to wind up here, these are some of the impact measures that we're looking at. There's quite a few of them. These have all kind of come out. You can imagine the grant writers here see this. You know, different things that funders ask for us to show. So jobs is always a question people ask. We're a little more focused on farm sales and profitability. Our, you know, gold standard that we want to get to is a really solid measure of how overall farm household net worth has changed. It's the best standard, but it's also the hardest to measure. So we continue to struggle with that. We just don't always have all the data we need to see that change, even though we know it is changing and we have lots of anecdotal evidence that it's changed. It's hard to get all the data to truly quantify that in a way that would say pass peer review. Other measures here, you know, you can sort of imagine that sort of goals that we set for our program, similar to the ones that you set for your program. And in terms of looking forward, we're just on the tail end, coming out of our last 5-year strategic plan and going into our new strategic planning process, starting tomorrow. Literally, staff is leaving for a 2-day retreat to work on that. Some of the things we expect to come out of strategic planning would be expanding our reach beyond California. So hello, our friends and neighbors to the north. We are already in a pretty substantial partnership with NABC and looking for other partnerships, as well as deepening our reach into low-income areas of California. And then continued pursuit of excellence in the business support that we provide and in the employment experience that we offer to our increasingly diverse workforce. So that's it. We're about on time for most of this program being devoted to questions. So I'm going to stop sharing. Did I stop sharing? I did, right? Okay. With that, we're ready for discussion.
And I will wait and make sure none of the other audience members have questions, but I have a couple ready. Well, since I don't see any hands up, I'll just get started and feel free to jump in. First, just one clarifying question, which I'm pretty sure I know the answer to, but I thought you had mentioned RCDs, and I don't know, maybe that's just my own not knowing, but it might also be regional. Is that, I'm guessing it's the CD is conservation district? In that, well, I don't know what the R stands for. I think that maybe it's slightly regional. In Washington, we just call it something different.
The Resource Conservation District.
Oh, okay.
They were,
See, yeah, I've never heard that.
They came out of a Farm Bill in the 80s. It was a 1980s Farm Bill era program under NRCS that created this new mechanism of in DC, they call them RC and D. I never understood why there was an and in there. Resource Conservation and District makes no sense.
No.
But anyway, they've been on the rise for a long. Well, they've been sort of rising and falling,
Okay.
and there's great diversity in how they operate.
Right. We work with lots of conservation districts, so I just wanted to clarify in case anyone else was confused. And then I figured I would also, I know Reggie had mentioned not knowing any agricultural CDFIs in Washington. I'm wondering if where would a good place to be to start looking for these kind of agencies in Washington, or organizations, I should say, in Washington?
Great question. Yeah, and I should have done a little research prior on that for you all. But yeah, and somebody just posted Craft 3 works in Washington, and that was the first one that came to mind as well, because I know they do work in particular with Latino and Latina small businesses, including farmers. So, but you can just go on the web and on the CDFI fund site and get a list of all the CDFIs in your state, and then you can kind of start to figure out which ones might be the most likely. And this is the kind of coaching we've done with some others in other states, just to, and or meeting CDFIs at the annual trade association meeting called Opportunity Finance Network, OFN, and who are interested in agricultural lending. And so if they're already serving a rural area, they might be getting farmer requests. And so just try to piece together which ones might be the most likely to be able to help out. And refer them to us if they're interested in learning more about how we couple the USDA programs with the CDFI fund programs. And we feel that this is quite a strong business model, if you will, this kind of combination of the foundations putting money into our loan capital pool, and then the philanthropic and government support for grants. And as we've grown, we've even been speaking more with like wealth management firms that want to invest their clients' money in our loan pool.
Excellent.
So I'll just say, in my experience working in Washington State, there are a number of CDFIs that are doing food, mostly food, some food and farming, but there's none that are heavily concentrated in agriculture.
Well, I'm a member of the Industrial Credit Union up in Whatcom, so that's great. Thank you, Addie. We'll be sure to put all of the links in the chat in our resource document that we send out later. That's really helpful. Thank you to Victor and Addie.
That's great to hear about that partnership with the food co-op in Bellingham and the Industrial Credit Union, which seems quite similar, potentially quite similar to those ones that I mentioned with the two food co-ops that we have. And just building on what Poppy said, yes, there's a whole pot of funds that are set aside within the CDFI funds for what they call healthy food finance. And that is focused primarily on retail store development in food deserts, but so it's a food access focused program, but they have also branched out into other kinds of food systems infrastructure like food hubs and distribution and that kind of thing, aggregation, etc. But again, very few CDFIs that are actually directly doing lending to farmers. So glad to learn about the Industrial Credit Union.
Addie, I see your hand raised.
Yeah, greetings. Show my face.
Mhm.
Thanks for the great presentation. It's really nice to learn about all the work you're doing. This is a little bit of a curveball question, and I apologize in advance, but I've been following some of the news coverage around State Farm insurance ceasing their insuring of homeowners across California because of the risk exposure. And it made me curious. In my own farming experience, had a hard time getting insurance coverage that I could pay for on, farming on a really small scale. Curious whether you're starting to run into farmers having issues securing insurance coverage because of climate change related issues, and whether that's a space that Farmlink has thought about moving into.
Yeah, we've got a significant proposal out right now to significantly expand our work in insurance for just this reason. Insurance is a huge issue for us. Reggie can speak to how it works on the underwriting and lending side, but I know on the education side, we do focus a lot on insurance, and the question over and over again is, where do I find an agent who can work with me? And I did everything you told me to do, Poppy, and I spent days researching, and you told me about all these different kinds of insurances that I could get, but my reality was I could not access any of those different insurances that you put in your nice theoretical PowerPoint slide. And that is the reality, and that was the reality even before the devastating wildfires. And it wasn't even wildfire issues, it was just exactly the same thing we see with lending. Farming's just a little bit too different for people to specialize in. Most mainstream businesses have a lot in common, and farming is this outlier. And, so what I do, and Emily and I have been working with this through the Northwest Resilerator. Emily, we have that sheet still we could share with Addie, right? From the Resilerator.
Yeah.
We have a crowd share document where we get farmers to just share their, where they find the insurance agents that speak farm. In California, where we are, there's a couple of communities which still have a really healthy concentration of ag industry focused businesses, but small farm focused. And we kind of send people from all over the state to those two small communities, not because they're closest, but because those communities speak small farm. And then Reggie, I don't know what you want to say about how lack of insurance affects underwriting, but just writ large, yeah, we could underwrite more if there was more insurance.
Yeah, I think there, many kinds of insurance, but most of the farmers that we serve who are diversified, small veg, and a lot of strawberry in the coastal regions around here, have historically not been able to access crop insurance. So not what you were talking about. You're talking about ability to insure structures, right? And in terms of the fires. And so, yes, I think farmers like homeowners who are living in wooded areas in California, in Northern California, are impacted by those same things, the ability to insure their structures for fire. And I don't know the details about where that's going, but it's a great question, or where the state has landed. I know the state has, backed a lot of those homeowners who lost their insurance. So I don't know to the extent whether a commercial business is also being provided with, state sponsored, safe harbor or whatever it's called. But some lenders in other states, kind of one of the reasons that they might not make a loan to a small farmer would be because that farmer isn't able to access crop insurance. And so there is a new, whole farm revenue crop insurance that is supposed to serve diversified farmers, but again, it's still out of reach of most of the small farmers that we serve. Yeah, so we're definitely thinking about it. Go ahead, Pop.
Well, just the whole area of risk management, right? So one of the reasons we talk to farmers about working with an agricultural lender as opposed to a different kind of lender is that once we're together in a loan, we're somewhat, and I don't want to use the phrase business partners in a legal sense, but in a layperson sense, we're partners in a business venture and we're both on the line for losses, right? And so we're both interested in risk management, right? So obviously we're going to require property insurance on property that is securing a loan. But the property insurance piece is what you're pointing out, Addie, is harder and harder to insure. Not that hard to insure a tractor, not that hard to get a tractor loan. It's really hard to insure frozen meat inventory. That's one of the emerging issues that I'm seeing again and again, is that farmers have some very substantial investment in frozen meat inventory. It's a lot of money. The farmers themselves do not know. A lot of times they don't have the inventory procedures to actually have a handle on the value of their meat. So they're sort of overlooking it in their mental calculus. Like they kind of wonder where the 100,000 went. They're not really seeing it's like, no, there's $100,000 sitting in your freezer right now. And then when the fire comes, it takes out power and they lose their inventory due to fire, but not due to the flames taking the inventory, right? So the fire insurance doesn't cover them. When they go to seek product insurance, that's extremely specialized, hard to find. Most of them are basically uninsured for large amounts. And credit is part of a risk management strategy, right? So if you're going to be uninsured on a large item and a disaster is going to come, there's a, more than 1 in 10 chance that a disaster is going to take out that item. You have some cash savings. What else do you have? Your credit score, your ability to access credit for recovery. So, credit is a key part of a risk management strategy, the ability to access it and manage it. And so we would be there either with new credit or to help them, renegotiate and use their existing credit in a strategic way to help, given that they are uninsured for some of these very significant investments. And the same goes with trees, right? You can lose all your fruit and nut bearing trees and there's no property insurance for that. And I'm working with someone right now, honey beehives, right? You get varroa you get a fire comes through, whatever. There's a million ways you can lose the beehives, and there's almost no ways you can insure that property the same way you would insure a barn.
And I just add that, I mentioned a little bit of this, but during the pandemic, when there were a lot of people who were either going to go out of business or access perhaps some of the government grant programs, one of the main, or relief programs, one of the main ones in the beginning, I think coming out of the CARES package, the initial big package, was the Paycheck Protection Program. And so because we already had a relationship with the Small Business Administration as a guaranteed lender under their Community Advantage Program, we therefore had access to the PPP program and registered as a PPP lender, and and I think proceeded to make about 4.5 million over the next 2 years in the forgivable PPP loans, which were instrumental in keeping people going, through that period. And at the same time, we also received a $2 million grant from Wells Fargo, which, because they were as part of their repentance, they were making all of the money that they earned, which I think was 400 million, from doing PPP loans. because there was a fee that the government paid of about 4% typically. It varied. And they had such a large volume of PPP loans that they had 400 million in revenue from it, and they gave that all away philanthropically. So we received 2 million, which we committed to making 0% loans for economic recovery to small farmers. So first of all, we accessed capital. We used our own existing reserves of capital to make those forgivable loans. And then once the paperwork was completed, the government reimbursed us. So it turned into a grant for the farmer. And then we also got this philanthropic capital that we started to grow this 0% loan program within our lending that we've now shifted over to not only economic recovery, but also recovery from fires, recovery from the floods and severe weather this winter. So it's come in extremely handy to be able to figure out how to provide 0% interest or low interest kind of relief lending.
And Caitlin in the chat asked, she wanted to hear more about your work with community land trusts.
Go ahead, Reggie.
Sure. Well, with community land trusts, okay, as opposed to just land trusts in general. Caitlin, you're kind of specifically focused on community land trusts? Because I can't say that we've worked a lot with community land trusts, but yeah. But I'm very intrigued by the model, and it's certainly something that we've been in conversation about. And I think that in the CDFI world, there are certain CDFIs that are using that model in housing, in affordable housing development, where the owners of, where you can be the owner of an individual unit, but the CDFI owns the land underneath the block of housing, apartments or condos. So, and I think, I'm not sure which came first, the agricultural community land trust or the affordable housing community trust idea, but I think they developed around the same time, 40 years ago or something on the East Coast. But so we don't own land and lease it to farmers. We've made a point of not owning any agricultural land. We're just trying, it's kind of part of our wealth building strategy is to have the farmer own the piece of property as an appreciating asset when they get to the point where they can manage the risk of, a down payment on land, typically an 80%, of the loan. We would fund 80% and the farmer would fund 20%, but sometimes even farmer would be in for less than 20%. So let's see what else about community land trusts. Poppy, do you have anything else on community land trusts?
We're always working in some fashion with advancing models for using community land trusts for land tenure. We don't have a lot of substantive partnerships to show for it, but we are always involved in something that involves these models. They just haven't gotten a lot of traction. We have a lot of interaction with land trusts that are not considered community land trusts. We have a lot of engagement with them, and not just land trusts, but also like one of our key partners is Sonoma Ag and Open Space District, which is property tax funded. They're like a land trust, but they're a special government agency, but functionally like a land trust in terms of their mission and holding ag easements. And so most of our work is with land trusts that are other than community land trusts. But again, always exploring how to apply that model. And we have two pretty substantial projects that we're on right now that are both long-term projects to explore some of the legal mechanisms for advancing a community land trust model into agriculture modeled on the like how housing co-ops work, modeled on how Habitat for Humanity works, to create quality land tenure opportunities using those mechanisms, but in agriculture, where there's other zoning issues. Like my analysis is we'd have to create an entirely new zoning mechanism at the state level and then deploy that zoning mechanism down at the county level before we could actually implement some of the things that are now like in the theoretical sphere.
And just I'll add one thing quickly, that it's not a community land trust model, but it is a way that we've worked with land trusts where we've had investors put up designated capital at very low interest to California Farmlink, sometimes 0 or 1%. And the restriction on that capital is that we use it to help farmers buy easement protected land. So we can greatly reduce the interest rate to a farmer who is buying land that has been protected by a land trust. So it's kind of a three-way partnership with the farmer, well, or the investor, the land trust, and California Farmlink, who's providing the low interest capital. So that's a model that we would love to see grow, and in the conservation arena.
We were right at time.
We are, and I'm not seeing any more questions. How often does that happen, that it's so perfect like that? Very rarely. Well, I think, yeah, everyone's welcome to sign off now. Thanks so much for coming, and I'll stay on with Poppy and Reggie to do a little after lunch and learn chatting. Thanks, everyone.
Thanks for having us.
I will stop record.